one thing that people get excited about with this market is that if you were to plot past markets and you look at the decline during the recession versus the subsequent decline, you get a very tight pattern, such that we could put a regression line along that. And what this regression line is telling you basically is when you've had in the past a mild contraction in the economy, typically it's followed by a mild recovery. Alternatively, when you've had a severe contraction in the economy, you get a very robust recovery. The good thing or the bad thing about this market is that we've had a very severe contraction. And so if you were to look where we would be on that regression line, we've had about a 4% decline. You get about a 7 or 8% increase in GDP growth. And so when people look at that decline, they say, you've had that decline, you got to get that recovery. And that's why a lot of people think this market is that V-shaped recovery. So is that what we're seeing in the market? Well, let's have a look at GDP growth. You can see that severe contraction, down 4% year over year. Has it improved? Well, 2009 GDP growth was 2.4%. That's hardly a robust recovery. However, in the fourth quarter of 2009, it improved. The GDP was up almost 6%. That is very robust. So that is why we have the big bird up in the corner there. That's showing you economic growth. So far, it's 1 quarter of data. That's showing a very strong recovery, maybe a V-shaped recovery. What about consumer confidence and retail sales? You can see retail sales in February up 0.3% versus January, not very robust, but the year-over-year number up almost 4%. That is pretty good. So that, again, is indicating that maybe you've got that V-shaped recovery. And you can see the gray bars are the change in retail sales. That definitely is a good rebound, coming off very depressed levels, but still very encouraging. What about consumer confidence? You can see the index in February, 46 versus 56 in January. It actually pulled back. So consumer confidence isn't following through or isn't showing you the same kind of data we're seeing in retail sales. And in fact, if you look at the blue line, which is consumer confidence, that actually follows that sort of square root recovery. You're seeing the recovery in consumer confidence stall. And that's why we've got the count up there on the corner. Now, next, moving on to housing prices, you can see here, housing prices in December, month to month, were up 0.3%. Not very robust, but not too bad, certainly better than the declines we're seeing. Year over year, it was still down 2.4%. Still negative, but that's far better than the minus 20% this time last year. So you can see in the red circle, we have seen an improvement in housing prices in the US. And so that leads to the question, has the bottom been reached in the housing market? Are we looking at a recovery in the housing market? Well, if we look at existing home sales, we would say not. If you look at January, existing home sales down over 7% versus December. The year-over-year number is very good, still up 11.5%. And as you can see from the arrow moving up, we did see good momentum in existing home sales, but the last few months have reversed. So we're not so sure you're seeing stability in the housing market. Plus, you can see that 7.8 months, you have a 7.8 month supply of inventory on the market. In other words, it would take 7.8 months of existing home sales to clear out what you've got for sale on the market right now. That's better than the 11 months we saw last year, but it's not near good enough for the 6 months that you need for what is considered a balanced market. So overall, this isn't very encouraging. As bad as this is, or as negative as this is, what really worries us is this next graph. You can see here, there's conventional inventory of homes for sale, and then there's this big shadow market. And what a shadow market is, it's homes that are owned by banks that they've got through foreclosure, and it's also homes that they're about to own because they're in the process of in foreclosure. And it's estimated that there are 5 million homes in the market right now in that shadow inventory that's waiting to hit the market. That's about a 10-month supply of homes. So you add that to the 8 months we already have, you've got a very saturated market. And it's hard to imagine how the housing market and prices can continue to go up with that kind of supply waiting to come on the market. Not only that, but it's estimated there's about 11 million homes that are in negative equity, meaning the home is worth, the mortgage is worth more than the home. And what we're seeing in the marketplace in the US, a lot of people are opting for what we call a strategic default. They can afford to pay the mortgage, but they're so far underwater on the home, they just walk away. And if those homes enter the market as well, then that's additional homes that have to be worked off. And so we look at this and think there's a number of years before this market recovers. So that's why we have the count up in the corner. It doesn't look like a V-shaped recovery in the housing market. Looking at the employment market, this lines, and I know it's a lot of lines, but you want to concentrate on the red line. And what this is showing you is it graphs the current recession versus past recessions on the percentage of job growth and the length of time it takes to recover. And you can see from here, just visually, this recession has been deeper and is looking like it's longer than past recessions. Past recessions have ended usually anywhere from 10 months to 5 years. We're already past 2 years, and it's still getting worse. We're still losing jobs in the US. In fact, in February, we lost 36,000 jobs, which again is better than the 650,000 jobs we were losing last year. But we estimate, or the market estimates, that you need to create 100,000 jobs just to keep up with the new entrants hitting the market. And you probably need about 200 new jobs to dent this job growth. So again, this job market, is it getting better? Will we start to see job creation? Yes, but it's going to be a slow go. And one of the reasons why we think it's going to be slow going is that if you look, a recent Wall Street Journal survey showed or indicated that 25% of the jobs that were lost in this recession are not coming back. Even if the economy improves, those jobs are gone and gone for good. We always find new areas where we create new jobs, but it takes a period of time. And we would agree with this survey. In fact, we would point out the manufacturing industry lost about 2 million jobs during the recession. As everyone knows, a lot of those jobs have moved offshore down over to lower labor cost regions. They're not coming back. Two other sectors we'd also think aren't coming back is in the construction and the financial industries. Combined, they also lost about 2 million jobs. These two sectors, this is where the financial bubble was. It was the housing market, it was in financials. We don't think those jobs are going to come back anywhere near to the amount that was lost. And in fact, if you look at the financial area, this is an area where we're just going to have more regulations, and that's going to serve to dampen the job growth in this sector as well. So we don't see a rapid improvement in the job market in the US.